All right. Well, good afternoon, everyone. I'm David Lilly, founder and CEO of Reap Capital. I've got Brent Cheney, my director of investor relations, on with me as well. And we're going to talk about the Landry today. It's 288 unit multifamily value add deal in North Arlington. It's a suburb right outside of Dallas. So first, before we get into the deal, I'll kind of give you a rundown of us as a firm and my background. So I got started in real estate investing in 2013 with the purchase of a single family home. Pretty quickly after that, decided real estate was where I wanted to invest. What's the best way to scale moving forward? And I decided to just jump right into multifamily. So I bought the first 6 units in Tampa in 2018, and then a 16 unit shortly after that, and it's just kind of grown from there. So the Landry will be our 10th acquisition. At this point, we've acquired more than 785 units. And prior to that, I was a Marine for 4 years out of high school, firefighter, paramedic, and then I worked about another 4 doing diplomatic security under both the State Department and Department of Defense. So had a long career in public service, some high stress environments, and I feel like that's relevant because it just goes to show that I've been vetted continually over and over again, and now everyone's starting to see the headlines. You've got Apple's Way, Nightingale, Matt Modal, all these fraudsters, and hopefully it reassures all of you listening that to know I've held a secret clearance with both Department of State, Department of Defense. I'm not just some guy. I'm the guy that has been entrusted to provide close protection to 4-star generals up to the Secretary of Defense. So that's me. This is our track record. Every deal we've done. And I'd like to highlight the last two. So Sierra Heights, we closed on the sale of that back in June of this year. We had owned it about 25 months. So you could say we bought it at the peak of the market, just like everyone else. Barely owned it 2 years, and we were still able to net investors a 37% IRR. So that was our greatest achievement to date. Not greatest returns, but given the market and a lot of people in our shoes bought the same time we did, they're just trying to make it out with their equity at this point. So we've also got another deal under contract that we bought. You can see February of 22, less than 2 years. No 37% IRR, but we're still putting a win on the board. And that equity from that deal, we're planning to 1031 exchange into the Landry. It'll be 3.5 to 4 million. You'll see we also did a self-storage facility back in 2019. Ironically, that was our best deal to date. 61% IRR, almost a 3x multiple. And so you could say we're value add guys, value add investors. After that deal, cap rates were starting to compress for self-storage to the same extent of multifamily. And at that point, multifamily is a lot more recession resistant in my opinion. So if we're buying, at the same price, essentially, I felt like, it was too overheated. We decided to focus on multifamily moving forward. So we're vertically integrated. We brought in property management in-house beginning of last year, construction beginning of this year. So we do it all. We're managing 560 units in Dallas currently, and we've probably got about 6 million in CapEx projects going on right now. So the single other co-sponsor in this deal and loan guarantor is Hensel Phelps. If you haven't heard of them, do a quick Google search. You'll find them pretty quick. They're one of the largest general contractors in the nation. So they do $7 billion in billion with a B in revenue a year, thousands of employees. So, the fact that they're investing alongside us, they're putting money in the deal, 1.5 million in Landry, and signing on the loan with me should speak volumes. So they've been a great partner, and they should be a very long-term partner moving forward. So they aren't, they're basically providing an advisory role as far as day-to-day operations go on the construction side. They're not running the show, but they're there to kind of advise and assist as needed. And they take part in the weekly asset management calls and stuff like that. Now I'll hand it off to Brent Cheney, Director of Investor Relations, to give you a rundown on the market.
Could you put that name in the chat, David?
Yes, I sure will.
Thank you.
Yeah, so market overview, we're focused in DFW. So we're based here in Dallas. Our office is approximately 20 minutes drive to any of our assets. But I think it's really key to understand why we're investing here in DFW as opposed to other markets, because we initially started in Florida, then we went to Arizona. But why DFW? And the metrics really speak for themselves. Migration. Dallas DFW Metro is set to take third place over Chicago by the early 2030s. It's a business-friendly environment. It's you have higher incomes by the average income for the median family here in DFW is 99,000 versus 88,000 nationwide. So higher incomes, better cost of living, no state income tax. So those all really point to fundamentally very strong reasons why we invest here. The reason why employment is so strong, as well as there's so many industries that are here and it's diversified. So DFW has 23 different Fortune 500 companies that are their headquarters are based here in Dallas. So that fundamentally is why we are investing in DFW, is due to the strength of the economy and the fundamentally strength of the multifamily space as well here.
That's right. Yeah, it's like Brent mentioned, all of our assets are a 25 minute drive from our office. So that's extremely important. Having boots on the ground with an intimate knowledge of that market and submarkets is invaluable. And almost all of our team has lived in Dallas 10 years, if not their whole life, and grown up here. So location is the first box we check in an investment, and we know it better than anyone else.
The market of Arlington, it says where this asset, the Landry, is going to be located. And there's all the metrics there. But one thing I would point out is we're 8 minutes from our most recent acquisition that we closed in July called the Chandler. That's in Grand Prairie, but it's like a 7 to 8 minute drive from one property to the next. The Arlington and Grand Prairie are adjoining communities. And that property that we closed just in July, we're just now initiating our distributions on that asset. So in a market where you're seeing capital calls and we're purchasing in a deal right now, we'll go through that in a moment, where they're wiping their equity completely out, bringing money to the table just to close the asset. We have an asset that we most recently acquired in July that have already started initiating distribution. So I think that's a pretty important thing to underline. And going further into the offering itself, the Landry, it's the current ownership of that is out of Canada. They're a very large firm, $4 or $5 billion AUM. They've had a great run prior to this, but just really had a very difficult streak. They took over their property management in-house 2 years ago, and just has been a disaster. There's the loan that this property currently has is with Benefit Street Partners, and due to breaching debt covenants, they're basically calling notes across 8 different properties with this ownership and forcing them to sell. So they have just a 2-year ownership in this, but they've called the note. There's no rate cap, so they're doing monthly rolling rate caps at this point. So they definitely have some stress to get out of the property. They're essentially wiping out all their equity and bringing capital to the table just to be able to get this thing handed off to a new ownership.
Yeah, that's
So
right. To provide some more kind of information, we get the question, what are those guys doing? And I believe that, we've probably all heard stories about some of the larger groups that rose incredibly fast, added billions in property in just a couple of years. Well, those were easy times, and it's pretty easy to just walk into a property and operate. But now times are different. It's very tough to lease, tough to collect rent, and they've got, like Brent said, they've got 8 train wrecks that they're having to deal with right now. They have no boots on the ground. Their closest guys in Phoenix. They self-manage, and I mean, we feel the pain too. It's tough to source talent. Like, it's hard to find managers. Surprisingly, it's hard to find people that want to work for 60,000-70,000 a year. And if you don't have leadership here on the ground, good luck. So that's kind of in a nutshell what they're dealing with right now.
yeah, I think it really underscores everyone's having challenges. Nobody's immune for what the issues that are going on. We're all facing the same challenges. And but what makes it one ownership and operations better than the next is really that focus, the detailed boots on the ground perspective. And so we're seeing that in all the assets that we actually underwrite. The only ones that actually are that are truly under distress are ones that they're really not, their eyes are not on the ball. They're focused on other things besides the asset, and most of them are out of state ownership and trying to vertically manage their properties. So kind of going into
Sorry, Brent, before I forget, I just wanted to highlight, in terms of deals that we've looked at this year, and I looked at the numbers a couple of weeks ago, and it's probably higher now, but a couple of weeks ago we had underwritten 206 deals this year, made 6 offers, and we've closed on 2 deals this year. So that just tells you, and the Landry is one of those 6. So good batting average in terms of, once we submit an offer, it gets accepted. And large part that's due to, the fact that most of these deals that we pursue are either off market or we know they can be preempted. So, but we've seen quite a bit of deals this year. They just, a lot do not pencil. And, this has been the, best penciling deal all year, if not, past couple of years. So continue, Brent. Sorry to cut you off.
David, can I ask you one question, David?
Please.
Okay. Great background, David. Thank you for your service. We really appreciate that. Coming to this, your bridge loan is almost $25 million. And what cap rates are you achieving when you're getting the loan at the current market conditions?
Yeah. In year 3, we're going to be north of 9. If
You're
that
right.
tells you anything.
Yes.
Yeah. 9%. So, these guys are operating, people might get turned off by the going in cap rate, but the simple explanation is these guys are operating at a 74% expense ratio. They haven't been able to operate, so they're just throwing more money into the deal in terms of payroll, admin, marketing, everything, trying to solve their issues. And it's obviously not working. So we are not being aggressive here. We're only projecting our income to increase about 10% from year 1 to year 2. The rest is just correcting expenses, taking care of the delinquency, getting the bad tenants out. So it's a heavy lift in terms of operations, but this deal it's pretty clean. Structures are good. Really the only exterior rehab plans we have planned is basically paint, refreshing the pool area, signage. But other than that, it's already a clean deal. It's just got, they haven't run it. There's a ton of delinquent tenants right now. We're going to have a ton of evictions, but we're prepared for that.
And what kind of cash reserves you have to handle that until you become profitable on this?
Yeah. What are we doing, Brent? 6 months?
Yeah, 6 months of reserves of expenses. So we definitely have some runway there.
Yeah. Yeah. On top of that, so the plan for the capital stack, we haven't used bridge debt all year because we felt it was too volatile. So we did one Lifeco loan that was fixed rate. We did another agency loan that was fixed rate, and that was a deal we closed back in July. And that was 5.8%. That same deal we'd be getting close to a 7% interest right now. So because treasuries have risen so much since then. So at this point, the Fed has pretty much signaled that they're done. They're done with their campaign. They're not raising rates anymore. I'm watching consumer spending pretty close. Some people are saying that the 2 trillion in savings that Americans had amassed during COVID is gone at this point. Others are saying, maybe it's first quarter of next year, but in either case, it's almost gone. And that's the best leading indicator we have, for the pending recession, crash, whatever you want to call it. Credit card debt all-time high, delinquencies on car loans and credit cards are climbing. So once all that consumer spending dries up and the stock market starts suffering, money's going to flood into treasuries and the Fed's going to have to lower rates. So all that to say, at this point, I'm okay buying a floating rate deal. And so it's bridge debt, floating rate, but we are buying a 2% rate cap. So we're going to fix our debt at 5.75, much lower than we could get in any fixed rate product. As far as reserves go, we're buying a 2-year cap, but we're also reserving year 3. And we're not spending that because I expect cap costs to come down. So it just doesn't make sense to purchase that up front. We're going to reserve it. That's another, what, Brent, 600,000-ish?
600,000. Yeah. The prices have come down, but we were reserving 600,000 for that.
Yeah. So that's going to be additional reserve. If, worst case scenario, if we needed it to get us through to a refi after year 2, something like that. So, yeah, we'll be pretty flush with cash.
And are you investing any of your capital in this?
Oh yeah, absolutely. The sponsors will have, I think 3 mil, 3.5.
Yeah,
And that's
3.5 million.
including Hensel Phelps 1.5. So I'm rolling in all my money from the 1031, and then some.
You guys have done any simulation on your cost expense scenarios on the whole financials?
Yeah, we've modeled negative rent growth and stress test the deal that way. So yeah, we've run all our normal kind of stress tests, and I mean, it's penciling it north of a 2.4 equity multiple right now. So we've got a lot of wiggle room, and I mean, we have not changed the way we underwrite deals. So this has by far been the best penciling deal that we've seen, and I mean, it's the first deal that we've looked at where sellers walking away from all their equity and even coming out of pocket to make the lender whole. So it's a pretty unique deal.
And is it possible to share the stress test you guys have done?
Absolutely. Yeah. We'll send you guys the model, our financial model. And then, I mean, we can pre-populate the rental increases, or we'll just send you the worst case scenario. And
Okay.
then you guys can tweak whatever you want in there too. It's pretty straightforward. There's one inputs page, and anything of a certain color you can change. So we'll send that out to everybody.
What's the existing pro forma based on? Is that based on rent increases? Like you're projecting rent increases, or
We're
I don't know if
modeling
I missed that.
is it 2 or 2.5% year 1, Brent? I think it's 2.
2%. 2%.
Yeah. So that's the best estimates we've seen for next year in this submarket, and thereafter it's 3%. So other than that, we'll go over our rent comps and how we arrived at that, but those are the main increases. It's through interior renovations and achieving those rent bumps through that. And we'll show you why our numbers we're going off are pretty conservative. And then the rest is just correcting their inflated expenses. Like I said, we're only projecting we increase income 10% year over year. So the rest is just correcting expenses.
At closing, what are you showing as your break-even occupancy?
I believe I ran these numbers a little while ago. I think it was like 65%. I mean, it was very low. So, yeah, I believe it was 65 or 70%.
Okay. And your loan to value, what is, I think you got that up here. Is it
Of cost, it's
Yeah.
going to be about 75.
75?
Well,
Well,
that's including preferred equity, 5 million preferred equity.
So, okay, so you've got 5 million of preferred equity. Does preferred equity have any carve outs as far as being able to take over? What kind of?
Yeah, they typically all do. They've got that, that mechanism. But I think of preferred equity as kind of a buffer. They're another equity source. They're not going to want to lose their $5 million. So if we screw it up that bad, at least there's someone else with equity that would be able to step in and hopefully salvage the deal. So I feel like it's a better scenario. But these guys, we know them well. They're Dallas guys. They're a small shop. So they're not in it. They're not loan to own kind of guys. We've got a good relationship with them, and we're excited to have them in the deal.
But that's included in that 5 million of pref equity is part of that 10.
It's part of what you see in the sources of uses right
Yeah.
here.
Yeah.
Yeah. There's bridge loan 25, 930. I think I can't see it because yeah.
Okay, so it's not included in that 10% equity then, the equity partners.
I'm trying to see what you're looking at.
Well, you
the
see
10
total
million,
equity
10
is 10 million.
Yeah,
But you got
they're not
pref
included.
equity is
They're not
5.
included in that 10. Correct.
Okay, so there's actually 15 of equity, part of its pref.
Yes.
Yeah, and in continuation to that, Terry left the meeting, but he had a question. Can you walk us through the preferred equity terms? Who is the provider, current versus accrual, redemption aligned with the breach loan? I think you answered the first part about who's the
Yeah, who's the provider? It's
provider?
Pine Peak Partners, and they're in Dallas.
Okay, and the current versus accrual, is it accruing or is it just?
Yeah, it's 6 and 7. So 6% current, 7% accrues, total all in 13.
I see. And
So
redemption aligned with the
redemption,
breach
yeah,
loan.
it's co-terminus with the senior. So if we refi, we got to pay them off. And if we exit, sell, we've got to pay them off.
So such a good question from Terry. I did not had, maybe this could go in our due diligence. The second question he has, does the bridge loan have recalibration loan pay down clause or debt test that could cause acceleration or pay downs?
There is, well, we thought we figured out who was going to be the senior lender, but they tried to sneak in some terms that we weren't thrilled with. So we're still waiting on their counter, and we're waiting on a few more term sheets to come in. So,
Yeah.
but to answer the question kind of generally, yeah, they usually all have some kind of debt yield covenants. And if like the one we were going to go with, 3-year base term plus 2 1-year extensions. In order to be granted those extensions, you've got to meet a minimum debt yield and debt service coverage ratio a lot of the times. So yes, to answer your question,
Thank
Terry.
you so much.
Thank
Yeah,
you.
I think I was talking to about recalibration of loan to him yesterday, and just it's scary if we don't pay attention to that. So that's good that you're working on those terms very closely. There's questions suddenly started, but if you want to go through finish your presentation, especially talk about what it means to the fund managers, I think that will be really great.
One thing I will mention on this is pretty important on the offering is that it's, you know, the depreciation is very amenable. So it's 80 to 90% depreciation year one for 2023, which is pretty important there.
Yeah, Brent, I don't think we
And
covered the rest of this if you want to go through it.
yeah, we could go through this real quick if that's okay. It's so basically as far as the rents, we'll go through the rent comps and specifically point out the properties that
Yeah, we'll get to
this
the
is the
rent comps.
property here.
Yeah.
Yeah.
Mhm. Before
So these are
photos.
some photos of the Brookside property that we're rebranding as the Landry. And so you can see that they've completely renovated the leasing office. So they did a great job there. And on the bottom right, you'll see a photo of the what they've done to the assets on 94 units. They basically have done stainless appliances, backsplashes, pretty nice level until you get to, they did cabinet fronts, but they didn't do the refinish counter. All they did was refinish the countertops. We'll be replacing those with quartz counters. So that's kind of like a partial renovation. We would just take it to a premium level. And like David mentioned earlier, this is the kind of a post renovation rendering that shows what we're going to be doing to the asset, which is painting it. So just a nice fresh aesthetic to this property. The next photo is the leasing office, just kind of freshening up in the front as well. Give you a kind of an idea there. Then as far as rent comps, there's a significant difference from where the in-place rents are now to what the rent comps other competitive properties are actually achieving. And you know, as you can see, what we put in there was what the property is currently in placing, and then also the pro forma, and it's what we're looking to achieve. And you can see a significant upside still available up there that we're not even trying to be the most expensive or nearby by any measure. The preserve at Turtle Creek is a property that went on the market a couple of weeks ago. And when we received their financials, these are numbers that we pulled from there. These are the for a very inferior product. You know, basically the refinished countertops and white appliances on their interiors are already achieving these high rents.
Yeah, we would consider those partial renovations if we were to do them. And it's literally across the street from the Landry. So very good comp. And you know, as you can see, we're not being aggressive in terms of post renovated rents. Yeah, sale comps we're buying this at a 40% discount to what was it, Jackson that traded? Which one
Right.
was that? Right. Yeah.
Jackson was the one that traded 173 a door. So that's directly behind the property. So it's not something that's going far away. The distance is yards away.
Mm-hmm. Yeah, most of these within 2 miles.
Here's the investment terms. So the Class A share is what we offer our investors. Just basically an 8% pref with a 70-30 split. So it's a preferred return to capital, and then 70% of the upside. That would be like a $50,000 minimum investment there. Then the Class B and C shares are the fund investors. So what Class B would be for a $1 million minimum investment would receive a 9% pref with an 85-15 split. And you can see kind of the metrics towards the bottom there. We'll be hitting close to 11% cash on cash. And then for Class C, which is for $2 million accumulative investment, would be 9% pref, 90-10 split. And again, these Class B and Class C do not have additional hurdles. This is a straight split. So you get to participate in the full upside.
Yeah,
And
and it's
again-
important to note our preferred returns accrue and compound. And also you know, our hurdles after we pay and satisfy the preferred return, we have to return 100% of your capital before we share in any profits. So a lot of groups do not do that. And they'll probably tell you it's better for tax reasons that they do that for the LPs, but it's while that's true, it's it's not a very material tax in my opinion.